Podcast is brought to you by the Resolve Long Horizon Investing Masterclass, a 10-part evergreen podcast series where Adam Butler, Mike Philbrick, and Rodrigo Gordillo of Resolve Asset Management Global explore an advanced investment framework specifically designed to steward quasi-permanent capital with humility and balance. From the science of decision-making to all-weather portfolio construction to the value of diversified alpha and tail protection, this series provides a comprehensive capital management roadmap to improve outcomes for wealthy individuals, advisors, family offices, and institutions managing less than $10 billion. To listen to the series or read the transcripts on demand, please visit investresolve.com/masterclass. Alternatively, you can find it on your favorite podcast player by searching for Resolve-Masterclass.
Happy Friday, boys.
All right. Happy Friday. Welcome, Wes. Cheers.
Thank you for having me.
It's been about
beers
a
up
year.
on Friday.
Yeah. Cheers, man. I got a little light sky. It's like a citrus wheat beer, low carb. And
yeah, I know. We're all old trying to keep our girlish figures intact. None of us are drinking real beer.
Well, I see you with a Corona.
Terrible.
Is
They're
Corona
too
light?
strong for me.
Yeah. The Corona's too strong for me too, man. I'm dying here. I actually got another call at like 5 for like official business, so I can't be actually drinking too much. So
no, just the right amount. You want to just drink the right amount.
You want to loosen up.
Yeah,
yes,
and just to remind everybody who happened to tune into these three scallywags talking on a Friday afternoon, none of what we're going to talk about is investment advice or in any way nature factual. It is entirely entertainment. So
that's right.
There you go. And with that, we're going to talk about lots of different stuff. Who knows?
Yeah. So just, a few things. Wes, thank you for coming last minute. We had a last minute cancellation. I know you and Patrick and your team were trying really hard to get everybody on. I think Patrick's going to join us hopefully in the next 15, 20 minutes.
Yeah, he'll be here. He's in the middle of doing some last minute work, but he'll be on probably 15, 20, I imagine.
Awesome. And I know you guys are working on big deals that we were hoping to talk about in detail in this podcast, but not yet. We have to wait for some regulatory approvals before we get into the details, but that is already hooked up for podcast hopefully in the next week or so. So we'll focus on everything else, your core business. I am actually dying to get a brief history of ETF Architect and Wes Gray, because I was talking to my wife today of the first time we spoke, and it was when I joined Mike and Adam in like 2011, and we're all starting this business together. Like we actually grew up together in this space, right?
I remember you guys were educating one of our longtime clients about, and he's like, man, you got to get on this phone call and listen to these guys. They're talking about, mean variance analysis, efficient frontiers. And at the time I was a prof, and that's what I used to teach all day. And I you guys were good, man. I was like, yeah, these they know what to talk about.
I'll tell you one thing that came out of that call that we have adopted at Resolve is, as we were walking you through what we walked your client through at the time, you kept saying, yep, I'm tracking. That lives on a weekly basis at Resolve. I'm tracking. Such a military man. I love it.
Yeah, that's true. I think that's a marinism thing. I'm tracking. I'm tracking awesome. On that.
I'm tracking.
That's definitely something they say in the service. Hasn't left me.
So let's start with tell me a little bit about the memory lane, because I want to go from the beginning. You actually left academia to start something, and you guys have what I've always found really interesting over the years is you constantly reach out to us to try new things. Hey, what do you think of this? Let's do a win-win. Why don't we try this other thing? You've done a bunch of pivots, like the definition of a VC, and I feel like you finally hit on something that's really working for you. And so why don't you give us a little bit of that history and that background? It's really, really interesting.
Yeah. You guys taught me about trend following, and we've just kind of adopted that in our business is the easiest way to put it. But so we're going way back to the beginning. How did this popsicle stand start? Well, I literally was doing what you guys do, writing a blog, and got cold called by a billionaire who said, hey, I'm firing all these hedge fund people. It's after '08. I read your blog. I read your dissertation. Can we talk? I said, sure, we could talk. So that was 2010. And then that was also right when I was starting up as a professor. So as I was literally on the professor markets, I'm getting like starting a business essentially at the same time. But you never know where the business is going. So I was like, I'll be a prof officially. That was 2010. And then we spent 2 years where it's just pure research. Really, we were just really working on behalf of the family to like make sure, what was they're getting pitched, what we were doing, etc. 2012, we got seeded SMAs, and it was all like you guys, inbound marketing. Random rich person would reach out, read a book. They're like, hey, this is cool. How do I do that? And that's just because that's all we knew how to do. And then 2013 came around. One of our clients had a big tax issue related to like a single stock position that had a super low basis. He's like, and that security was going to actually get bought out in a cash merger. And I was always like the tax guy, like, hey, solve this, figure it out. I was like, well, that's kind of a hard one, man. Like you have a $2 million position, it's worth 80, and there's a cash buyout announcement coming. Like, what am I going to do? But the rich person says jump, you say how high, which is what I did. And then I was at a conference and I learned about, you can't do this transaction. I will just say you could probably never do it. But through a conversation, I learned about ETF. And I learned about this whole thing of in-kind custom crates, and you could like put a security in a fund and then you could kick it out without having a tax. And I was like, holy cow, this is a tax deferral vehicle. We need to get in this business. And again, that was around 2013, but we were broke, didn't have anything. And then we obviously talked to some lawyers, as you guys probably have, and like, oh yeah, set up an ETF. Like, you don't just do that. And so we ended up raising some capital from one of our clients who's now one of our business partners as well. And then we got into the ETF business because of the taxes, really. And so we transitioned back and then SMAs to ETFs.
Because I remember we were also at the time, you and I were talking about the insurance, international insurance companies, and using that as a vehicle to try to, transition.
Yeah, that was another way to do it with like private placement life insurance, private placement variable annuities. And those are also awesome. And, we still we think those are good structures. But the ETF was just better for our purposes. We thought that's where the business was going because we're doing factors, right? Active factors. So then we got in that business. And that was, as you guys know, a long slog for I don't even know, like 8 years now. And then, and so now over time, we still have our legacy SMA business. Then we moved into like our ETF business. And, I don't know, it's probably 2.5 years ago now. Everyone knows Perth. Perth had reached out because we had always had people ask us like, hey, can you just let us use your infrastructure? Because we don't want to, burn millions of dollars on fire. And we're like, nah, we don't want to deal with other people.
Yeah, no, we were one of the no's.
Yeah. There's a lot of people. Yeah, it was just,
we were one of the no's. We went somewhere and did it, and you said, well, what'd you do that for?
Tons of brain damage. But Perth is very persuasive and persistent. And long story short, but she got all the things that we needed to do it. And we're like, you know what? Let's try it. And so we did that, 2.5 years ago. And then it turned out we were just idiots because one of the benefits of surviving in, the Terror Dome here for the last 7-8 years is we were able to vertically integrate, build every little component of the ecosystem, know where all the bodies are buried, and survive. I.e., we have extremely low cost infrastructure and capability that a lot of people don't. Well, I don't know why we were keeping that as a cost center because we can turn that into a revenue center. And we're actually a lot better, frankly, at ops, checklists, getting shit done than we are obviously at selling ETFs because we don't have billions of dollars in our ETFs. So then we're like, you know what? We should be shovel salesmen. Why are we being gold miners?
Picks and shovels, baby.
Yeah, we're not that great at gold mining, frankly. Our products are too crazy and it's just whatever. And then we've just been lucky because, we had that unique ability of like low cost access. and that's just what we do. And then we're just hitting this time where like everyone on the planet needs to get into the ETF wrapper, right? And and that's just good luck. So, it started with Perth, but now it's like RIAs want to transition, mutual funds want to transition, hedge funds want to transition. Everyone on the planet wants to launch an ETF. And as you guys know, their iShares isn't going to launch your ETF. Vanguard's not going to launch your ETF. And the number of people who actually have vertically integrated capability across the stack to run and operate an ETF, I can count them on one hand. And we all have different value propositions, and they're all great, and I love my competitors. And so that's what we do now. It's called ETF Architect. I don't know what the next adventure will hold, but
I see
it's
what
a
you
great
did there.
journey.
Yeah. We've done a few other things along the way,
ETF
too.
Architect. I get it.
I
get
mean,
what you did
it's
there.
it's just so difficult to. I remember we tried to launch an ETF before we took another path, and we did go through the whole process. Spent the $50,000 legal, had the prospectus launched. We were ready to pull the trigger. We sent the trading blotter, and they're like, "Oh, you can't trade those things." Right?
Yeah.
It was one of those like, "What? How can we? We just spent all this money and all this time." And I'm like, well, you're not allowed to because this is. And I'm like, that probably should have been addressed with legal in the first couple of weeks. You know what I mean?
Yeah.
It was just, and it was a wild, wild west back then. I think there was less integration with the partner that we chose at the time, but it is a wild jungle full of pitfalls, right? That is, and depending on what you're trading, where you're trading, it becomes. You need somebody with expertise and that type of vertical integration that you guys have definitely built.
That brings up a big question. I mean, maybe it's too early for this question, but I mean, there's a lot of different types of ETFs and a lot of different nuances between what the underlying purchases will be. We've had lots of experience in that in Canada with commodities. Certainly things like the DBO in the US have gone through several iterations of how they approach that versus sort of your sort of classic, hey, I want to buy 25 stocks or 50 stocks. Here's my basket. I guess the ETF landscape has gone through that arc of development from first ETFs with stocks, then some ETNs, getting into the commodity space, and then the active ETFs with Cathie Wood. So there's been this kind of progression that we've seen, but how is ETF Architect sort of thought through that process, and what's the landscape look like for that business as the complexity of the product expands?
Yeah, so I mean, we always try. We don't have interest in putting people in the ETF wrapper just because we can sell them a shovel. Because in the end, like when you run a platform, you're like getting married, and everyone's in the same boat, and we're in the long game. And so we're not going to put someone on our platform in the short run just because they say they want to pay for it, even though we're like, well, why would you do that? The ETF's not the right wrapper. You should do that in a mutual fund or a hedge fund. So a lot of the times on our platform specifically, we will tell them, no, you shouldn't do that. You shouldn't do micro caps because guess what? Susquehanna will fleece you and you will die. You want to do managed futures? Well, you shouldn't do that either because you can't use the leverage and it's totally constrained. And I
think that was your note to us.
Yeah, exactly. Like we're not going to have someone get into the ETF wrapper just because they think it's a good idea if it's not appropriate for the strategy, right? Yep. And so we always try to coach people on that as much as possible. And that's just because we're always trying to think about like, hey, you use the ETF to basically maximize the tax benefit, the transparency, and the access to anyone with a Schwab account can type your ticker in. But we've learned over time more and more on ETF Architect, Wes can't be a judge anymore because there's some for everyone. Like, so if I don't like the product, fine. Our new criteria is
we got to get you off that value podium.
Can you pay the bills? Will you raise money and be in this for a long time? And will you not blow us up on compliance? Even if I think your product's crazy and I wouldn't invest with my own money, it's just that's not our business. Shouldn't be in a position to judge product because we're just trying to give access to the market efficiently. And so that's our new take on it, which means that if you come to us with a unique, innovative idea and you have the story of how you're going to distribute this thing, and you're willing to pay the cost that it might take for us to, be able to do some weird, triple leverage Zimbabwe swap or whatever it is, we'll make it happen. It's a service business, not a judgment business.
Right.
And so that's what we focus on now.
Well, it's morally presumptuous if you start getting into the judgment business.
Exactly. I mean, so, but it is on us to make sure that if you're on the platform, can you pay the bills? Can you raise the capital? Because we've got 100% in the sense that every product we launch, we generally never want to have to close a product, and we haven't. I mean, we've obviously been in a huge bull market, so not saying it's been hard, but I really do want people on our platform, like we want to be a team, and I want them to be in business for 20 years.
Yeah.
So there is that requirement, because that's good for shareholders if we kind of pre-vet people on the thing. But and it doesn't really matter if Wes only wants to buy quant factor stuff. You want to be a stock picker? Great, let's do it. There's some great stock pickers out there. So we've had to all change our mentality of like our mission on investment size and power to education. Our mission on ETF Architect side is help ETF sponsors win, period. So that's what we don't really care what your strategy is. We're just going to help you win and achieve your goals in whatever endeavor, process, strategy that you want to, pursue. Basically,
I imagine this comes with a lot more niche products.
Yes.
And sort of what we'd call the explore products of the ETF universe. And how at liberty are you to talk about some of the products that you currently have in the lineup? We're okay with some of those, and I don't know them all.
I can give you the Archon.
I think I know, like Riggs, for example.
Yes.
Right. And that's a really interesting, very unique, niche ETF that I think is fantastic.
Yeah.
But is that when you find yourself seeing more of those kinds of things?
We kind of have two buckets. We have what they call an ETF Innovation bucket, and then we have like traditional bucket. And I'll explain. So ETF Innovation is you're coming to market as an unknown. You don't have $1 billion. You don't have an advisor that's already got a bunch of money. You're not going to do the bring your own asset thing. Mm-hmm. And I'll talk about those in a second. And so in ETF Innovation, from a platform standpoint, it's really important that you have a value proposition. And so if you're going to come to market and say, hey, I'm going to set up my smart beta value ETF, we're like, all right, roger that. Go talk to Title or talk to someone
exactly.
else. We're not interested. But if you're coming to us, and we see every deal right now, and you've got something really unique, something cool, and I'm like, that's a great pitch, and you're the person that should be telling that pitch because you have the right expertise. Even though I may not know anything about that specific field, you're clearly the author of this book. And if you have the capital and the backing, and we feel like you have staying power for like 3 to 5 years, even if you don't have like $100 million seed, we want to help you out, right? Because just like you guys, when you've been an entrepreneur and you've been broke for 10 years, like you just have empathy for people that are trying to get into the business, and you want to help them out. So we love boutiques and ETF Innovation, and you'll notice all the funds on our platform and those that will be coming to market, a lot more and more, they're going to be funded by like, some people in our syndicate, like on the operating capital. They're doing cool, unique things, but they're not coming to market with $100 million. That's ETF Innovation. On the other side is the bring your own assets. Hey, ETF is better for my clients. It's more tax efficient, and it's operationally 10 times more efficient. I have 500 SMAs. It's a huge pain to try to manage them all. I could just put them in one ticker, and the fees are tax deductible, and I don't have to pay I don't have to distribute capital gains. Those are totally different, and that's usually RIAs. And then right now, as you can imagine, there's a ton of mutual fund conversions because they're like, hey, I'm in this mutual fund that has capital gains and it's a pain. I could convert to an ETF and compete again. So those deals we're seeing a lot more of, and they're not as exciting, obviously, because innovation is like the shiny rock, but they're obviously from a business standpoint pretty intriguing because there's a lot less risk. Oh, you want to launch a $500 million fund day one? Roger that. We're
We're going to sign up.
Over, Roger.
Yeah. So and that's obviously what a lot of the product that we're bringing to market here in the future you're going to see is funds these are pros. These funds will be around for a long time.
Is this why Pat blows is blowing us off right now?
What's that?
Is that why Pat's off right now?
Yeah, exactly. That is literally, we are right now in the middle of welcome to the service business. Customer says jump, you say how high. That is the reason why Patrick Cleary is not here right now, is because on a Friday, late afternoon, we're helping out, our teammates to, try to get to this ETF market. You got it.
What do you assign the probability of maybe leveling of the playing field from the legislative perspective? Like there has been talk that, hey, this is unfair. Mutual funds are lobbying for some sort of leveling of the field, whether that's, hey, make those ETF bastards taxable or not. What are you saying there?
I am all about leveling the playing field in the sense that mutual funds should be granted the same taxation capability as ETFs. But I'm very against, for two reasons. One, conflict of interest. Like, I like the tax benefits of the ETF for my own personal capital, and that's our business. But then also it's just fair for consumers, right? Because if I buy an ETF with a massive deferred capital gain, I just bought a tax liability. Mm-hmm. That's an externality problem that shouldn't exist. Where an ETF, basically, it pushes out tax externalities to the client, and the tax decision is on the end consumer. And that's how it should be. That's the fair way to do it. So I think what they should do is just make sure that to increase competition and make sure it's fair to the mutual fund vehicle, which is a good vehicle for certain things. They're not appropriate for the ETF. They should find a way to make that have the same tax benefits and kind of limit the externality problems that, clients in mutual funds face. So I'm all about, fair and balanced competition. It's good for consumers, for sure.
Right. So can we just kick it back a little bit? Let's say I'm an ETF. I want to convert into an ETF, or I want to launch an ETF. Let's talk about the costs.
Yeah.
Right. So like startup costs, and then ongoing costs, and then any sort of variable costs that might come into play. Maybe you can break that down for us.
Yep. So it's real simple at a high level. It's to launch a fund, you're basically going to have an IPO. So as you mentioned, it's like 50 grand, light money on fire. And it's a ton of work, right? It's going to take you anywhere from 3 months on the ultra short end to 6 to 8 months, depending on how complicated it is. And if you're trying to launch like a Bitcoin fund or something, that could take you 10 years, right? But you're looking around 50K plus or minus, depending on complexity. But that's not really the cost. The real cost is the ongoing operating cost, where you literally just light money on fire big time. And I would say, I always tell people, for under 100 million, which I would call subscale, your all in kind of fixed costs across, fixed and variable, everything you could probably deal with, is going to be anywhere from like 225 to 250 is what we got it down to. Over time, we're going to try to get this down to like 200 on our platform. But that is soup to nuts, i.e. the only other cost you have is whatever you pay yourself to put together the spreadsheet to tell us what stocks and weights you want us to buy, because we're doing everything, right? And so you're looking at, let's say you're 50 bips, you need 50 mil basically to break even, which sucks. Wow. But why do people want to do this business? Jesus. Well, the marginal cost production after you've paid the fixed cost is usually around 10 basis points, let's say. It's subscale. Maybe you get it down to 5 or 6 if you're multiple billions. So that means if you charge 50 basis points, you get to 50 mil, okay, you're break even and you just lit money on fire. But now every dollar you get in, it's an 80% profit margin. That's a pretty good business, right? So I always tell people ETFs are really little software businesses in plain sight. And it's actually perplexing to me that there's not more VC and traditional kind of software technology type investors, because the pro forma of a ETF looks like a software company. Big fixed cost. It costs a lot of money to build the first CD, but then we don't have CDs anymore. But you guys know
they pump out easy after that.
Yeah, that's an outmoded thing. But the first CD is really expensive, and then to copy the CD, for anyone who knows what a CD is anymore, cost a penny.
Copy the CD to an 8-track and
Yeah.
convert
I don't
it
even know
into a
what
cassette.
is the equivalent today. What is like the Gen Z equivalent of that? I don't
There's
even know.
no equivalent. It's all online.
Everything's
There's
online.
nothing.
It costs nothing to make. What an NFT costs nothing, and it makes millions day one.
I suppose
without any
the
cost.
phone that they hold in their hands. I don't know.
Yeah.
very confusing.
I guess in their context, it's like, it costs $50 billion in physics and underlying engineering technology, but the cost production of the supercomputer in your hand is like whatever, $200. So they don't even have the equivalent of what we're talking about here. But you guys know what I mean. High fixed costs.
You're
huge
talking to the right
operating
audience. I
leverage.
think we all know what a CD is,
Yeah.
which is good. So I remember when we first started out thinking of raising $50 million or being on the hook for $220,000 a year is a massive proposition. I mean, you literally have to be insane to go from zero if you have no presence, if you have no, like you said, just saying I have a dream and I have some savings. How many of like zero, like brand new players do you get in contrast to people
So
that already
we've
have money?
launched a few, and we're going to launch some more. And basically this is our playbook for like bare minimum viable product. MVP is what the tech geeks call it. So we say, listen, here's what you got to do. Day one, you got to show up to our door with $500K in operating capital, because that's going to give you about 3 years of breathing room to stay alive in this business, right? Day one, also, you got to show up with $5 million AUM. Talk to your rich uncle, your grandma, I don't care who it is, but that's the bare minimum. And you better have a damn good value proposition and story about how you can be a brand in the marketplace as a boutique. And then your year one goal, 25 mil. Year two goal, 50 mil, break even, and now you're off to the races. And Perth is actually a perfect example of this, because that's basically what she did. 500K operating capital, 5 mil day one, talk to the rich uncle, your grandma, your buddies, whatever, and then grind it out to get to 25. Be like, work your niche, work your angle. And then she's obviously surpassed that because she has over $100 million now. But the idea is she is the prototype. Like, if anyone wants to be a boutique and a quote unquote no name and enter our business, and you want to know a model for success, go talk to Perth Toll, because she did it literally.
Well, we're gonna have her on in a couple of weeks, so
yeah, perfect. And there's there's a gentleman. What's the rules on it? Well, whatever. I'll just tell you. I don't know if he's going to launch an ETF, but let's just say a buddy of mine, Ray Micheletti. He's a Princeton PhD engineer, and you guys probably read some of the stuff. He's like he's big into relative sentiment indicators, right? Where he's kind of on the forefront of understanding, where is the timing signal related to, how institutions are positioned versus the retail. And he does all this machine learning stuff on like Centix data, blah, blah, blah. I don't even understand half the stuff he says, but what I like about it is it's totally different than trend following, right? And it's like, which I know, and any other kind of tactical management technique I've ever seen, it's way out in left field, because he basically invented this concept, right? He is the leader on this deal. And so someone like that is really compelling, because he's got the pedigree, he's been in the business for a long time, and yeah, he's not Cliff Asness, but I feel like he's got such a unique set of ideas, and he's got an ability to put that minimum viable product to the marketplace, that if he has staying power for 3 to 4 years, I think he'll find a market, because it's just an interesting, unique idea I've never heard. And I get, like you guys, I get pitched something 5 times a day, and I've heard it all at this point. And so there's things like that. There's cool stuff entrepreneurs are bringing to the market. It's just, it takes time, and it's hard.
It seems like the economics, like that equation, is sensitive to the fee you're going to charge too, right?
Yes.
So how do you guys think through that problem? How to price it?
So we're like, it's all about being in the boat together, right? So most of the time, if you're going to be an ETF innovator, the only way you can do that, i.e. you're a boutique, you're not going to be iShares, right? Just is what it is. But the good news is iShares or Vanguard is not going to be you either, because you're a boutique. You're doing something very unique, very niche, and your market is just super segmented. You're going to know the buyers, find the value proposition that matches those buyers, blah, blah, blah. So maybe your best case is you raise $1 billion, which would be awesome. You're going to be confined. You can't charge a ton, but maybe you're in that like 40 BIP to 80 BIP range, depending on what you're doing. And that's one business model. And we're, because that also has different risk profile on it, because, just is what it is, we charge a certain amount. Now, let's say, and we have had this happen, someone comes in with a big idea, where it's a big idea, it's a $50 billion product concept, but it's a super scale thing. It's definitely differentiated. It's very different than what iShares or Vanguard. They could probably compete on price, but this group could compete on branding, or whatever it is, their shtick. Well, in that case, you might need to get to a 500 million to break even if you're only going to charge 10 or 15 bips. We're willing to entertain that. That just means that your operating capital up front has to be much larger, because we, as the shovel seller, are not interested in owning your equity risk, right? Like we're not getting paid enough to take your equity risk. Like, our platform is cheap for a reason. We don't want any risk on it, right? So if you want to launch a 15-bit product that's got 50 billion scale potential, we'll obviously, and you got the capital that we can see in the bank account to float it for 10 years, we might do another form of deal that we would never do. Like, fine, we'll we can't charge you, 10 bips, on like marginal cost production if your product costs 10 bips. Mm-hmm. So we have to work a different arrangement. We're open to anything. Like, again, the mission of the platform is help ETF sponsors win, not help boutiques win, not help iShares win, not help. We just want to find a way to help you out, basically.
So how do you guys think about derivatives-based stuff, right? Like that, mm-hmm. We obviously, a couple of years ago, we're trying to figure out, can we launch our futures-based strategies in an ETF wrapper, and decided at the time there were too many compromises to be able to do it. Do you think have the rules shifted, or has the product engineering shifted to make that more viable now than then, or are we sort of stuck?
No, I think marketing has improved. And as you guys know, marketing can trump good product all day long. But the fundamental constraints and the fundamental benefits of derivatives through like capital efficiency, all these sort of things, they don't work in the 1940 Act, right? Like, they didn't even have derivatives and futures around then, or they did. No one knew about them or what they were. So, it doesn't work. For example, like one of the stupidest things, you're like, hey, I want to own a treasury future in an ETF, because that seems pretty like low risk. And, but let's say you have a treasury future and you want to do a 4 times leverage treasury future. Well, you guys know the collateral requirement's like nothing. So, mm-hmm. If you have $100 of cash in an account to collateralize a treasury future that's maybe 4 times the notional, that's not very risky. Frankly, it's hardly any risk, right? But the 40 Act would say, well, that's a lot of leverage, because this says 4x the time of your thing. However, if I were to go get a 10x, like if I went to go buy a swap from a bank, or like a structured product that effectively delivered me a 50x treasury bond exposure, but it only cost me $5 a notional premium in my fund, they'd be like, well, you have $95 and you have $5 in that thing. There's right. No leverage in that. And you're like, dude, there's tons of there's a million times more leverage in this than $100 in an account collateralizing a 400% future overlay. What are you lawyers smoking? But the problem is the lawyers run they run the rules. They're not quant finance PhDs and geeks. So they're getting there though. Like, I think like the new derivatives rule, they're trying to get like the VAR where it's getting more.
But why is it
tangible,
harder in an ETF? Because I feel like the 40 Act constraints, I could be wrong, but I feel like the 40 Act constraints are kind of the same for ETFs versus regular 40 Act funds.
We
right?
addressed
mutual
earlier,
fund?
Adam, was the advantage of being an ETF is the tax wrapper, the tax advantage.
Yeah.
Right?
Well, and distribution.
And
right?
Yeah, and access distribution
Access, yeah.
potentially. Yeah.
Yeah.
so
But there's
maybe we
not
should
really
touch on
any-
that.
Yeah, and
me-
there's transparency
let me
too.
put it-
Yeah. Or sorry,
Yeah,
Rodrigo,
this
what were you
like
saying?
sorry. Let me just. I think we talked about just to bring you up to speed because Adam joined in Patrick's absence. So we did discuss the fact that the tax efficiency is the same. You're going to get the same tax benefit in a let's say futures based product in 40 Act
Yep.
as you would in ETF. I think the other things we've discovered is the market makers have a harder time market to market on futures contracts than they do necessarily on.
No, I think that's the core challenge, right?
Yeah.
That's kind of what I was trying to get to. Sorry if you guys had already covered it. I obviously can't.
No.
No,
This is we're
makes
exploring new
perfect.
areas. But let's
Yes.
talk about the distribution angle. So my understanding was that ETFs have to go through the approval process across platforms in the same way that a mutual fund does. Am I incorrect in
Not
that?
true. So
Okay.
so ETFs have an infinitely better time, right? So if you're a mutual fund, and I didn't even know about this until recently, but like you want to be on Schwab's, platform to get access, because of the transfer agent fees and all this other stuff, they'll charge you usually like 10 bips. Every time you make a sell, they take 10 bips of it. That's not even to be on like the preferred or any of this stuff, or to be the commission free. When we launch an ETF, day one, you are available for trading on Schwab, and there are zero costs to anyone, right? There's costs through like payment for order flow, but like there's no commission, there's no weird behind the scenes, like, hey, give us a cut of your
Platform fee and stuff.
Yeah, there's none of that. So
The something B funds, the something B. Anyway, doesn't matter.
yeah, I don't know, but so mutual funds come at the world through an ecosystem that just likes to rape and pillage on them. Whereas ETFs, I don't know how we pulled it off. I wasn't part of this, but obviously, when you launch an ETF, you're available on all open architecture platforms essentially. If you're trying to go to a wirehouse like Merrill, obviously, they're going to tell their clients, oh yeah, you don't want to do that fund. It hasn't done due diligence. And then magically, if I go talk to the department, I said, hey, do you want $1 million? All of a sudden that fund passed due diligence. So there's a lot of backroom, crazy.
Dealing,
when you dig in the weeds on these things.
Okay, so default is being ETFs are on. It really
You're on
it's
zero
on
cost.
it's on the platforms to turn it off or disincentivize
Yes.
people to invest
Yeah.
in ETFs. So you got the advantages of distribution. I guess for those who care, the advantages of trading intraday. The tax advantages if you're doing some sort of. So let's talk about what type of ETF underlying products can benefit from this tax advantage and how that works.
Yeah, so the only way you have advantage is if you can do something in kind, right? Which really boils
Patrick.
down to, hey Pat, what's going on, man?
What's up? Resolve Riffs.
Dude, are you
Grab
in
a
the
drink, man.
old AA headquarters there?
Are you an AAHQ?
That looks familiar.
This is like an old North Korean banquet hall. It's like
Did Wes
Oh, it's
give you
familiar,
his
dude.
house when
It's
he left?
familiar.
Did Wes
Yeah.
just give you his house when he left? He said, "I'm just."
Frank, we got to keep costs down, and we got to launch these ETFs, man.
yeah, we run a golden corral and a small here. We're just
Show us the bear, man, and the leopard and stuff. Is that
the leopard. Yeah, so we got all the weird
Oh, that
stuff
place brings
here.
back some memories, dude.
Yeah.
Yeah.
Yeah, we got.
There's the
Sorry,
ram.
it's tough to be a. There we go. And this is.
Grizz is downstairs though.
Yeah, Grizz
That's
is-
the Jaguar.
Yeah, right.
Grizz is downstairs. We got.
He's the co-host for the podcast for a while. If I
Yeah.
recall.
That's right.
Yeah,
Yeah. Some dinners at that table.
yeah.
That's right. that I barely remember.
Do you guys want to see Wes's collection of Justin Bieber DVDs? He's got like 600.
We were just talking about CDs and DVDs as well.
Can you mute
He's
him now,
Canadian,
guys?
man. I'm all for it.
I love the
I'm all
Biebs.
for it.
Who
I'm a big
doesn't love
Beeb
the
fan.
Biebs?
Big Beeb fan.
Too good.
All right.
Welcome, Patrick.
We can
I'm
go
sorry I'm
deep
late,
now.
guys. Yeah.
No, that's cool, man.
It's okay. I've been dying to get off this freaking transparency, tax, and access crap. I mean, yeah, I get it. What I want to talk about is innovative products. Shit that's on the cutting edge. I mean, stuff we've had in Canada for months, but you know, and potentially years, you know, really. Anyway.
We
Anyway,
always
you guys-
lead you guys. You know, it's okay. We all know.
Don't worry. We don't have to name anything. I know we're gonna.
Nobody's
it's
naming
a
anything.
Veil of secrecy for now. But yeah, we were.
Let's say
talking about
someone did
these
want to
products.
launch a crypto futures fund. Well, how would they go? But no, I'm just kidding. But that's
Well,
That's super
here's an
exciting.
interesting thing, Adam. I was talking to Wes and Rod before we were on, and I was noticing, obviously in Canada, we launched a couple of different digital asset products, one for Ethereum, one for Bitcoin, and our former futures head of futures trading, Sean Cumby, who, by the way, just launched ARX Novum in Canada and is now registered and whatnot and doing some fun stuff there, and is legitimately the GOAT in Canada that helped 3iQ launch and navigate the regulators in Canada in order to get them comfortable with the initial closed-end offerings of the Ethereum and Bitcoin funds.
Right.
And then subsequent to that, with those having such smashing success, you saw Purpose and Galaxy and 3iQ also launch ETFs. And then subsequently to that, you've seen the ETFs launched by companies like Horizons, which are based on the futures rather than the coin.
Right.
And there's a lot there. What I was surprised at was basically how closely the Horizons product in Canada had tracked both the physical ETF in Canada, as well as, you know, looking at BTC spot in Canadian dollars. I don't know if I can just share my screen and show you this. This is pretty interesting because hats off to Horizons for being able to do this. But let me share my screen on this one.
Ladies and gentlemen, first Mike Philbrick screen share in the history of the podcast.
I don't even
It'll be about 20 minutes. We'll get there.
This is very
okay.
exciting.
Get those big thumbs of yours working.
Share this one here. I think is that the one.
First
Okay,
boomer
does that-
screen
does
share
that-
on the
does that-
podcast.
Does that show? Oh, good. I got the right screen. I
He's
thought
got
that
his-
was going
he
to
got
be the
his
one with the
Fortran
small
code
people.
to work, guys.
All right. I thought that was going to be the one.
This is running on
Anyway.
the AS400, right, Mike?
Yeah,
Hey,
exactly.
it's a not coprocessor. This thing's firing up great. So anyway, this is
pretty
This
close.
is HBIT, which is the Beta Pro Bitcoin ETF in Canada, which is the futures based one. Then you have
In Canadian dollars.
this is all in Canadian dollars because of the charting system, whatever. So BTCQ also Canadian dollars, but is holding the underlying. And then you've got BTC USD, but then I've translated that into Canadian dollars by dividing it by FXC. And you can see the tracking is astonishingly close. And I'm actually quite surprised because I thought there would be a much more difficult sort of role issue.
That's shocking, actually.
In
Yeah.
the Bitcoin futures. And so, you know, what I'm hearing from, I was talking to Sean Cumby the other day too, what I'm hearing is that a lot of the institutions that are looking for access, there's a couple things they really want. They want to know what's the index that you're tracking? Like what can I benchmark you against, and how are you doing against that? And so, you know, what expertise or what background do you guys have in this, and what are your thoughts on you know, the sort of the Canadian experience? And there's a lot of talk of this coming to the US in the coming weeks.
In theory.
In theory, theoretically.
Yeah, so I don't know if you got the ability to do it, Mike. How does ETH look? Is it similar story?
Well, That's a great question.
Futures,
I
right?
can try. Let me just see. Well, the problem is that we don't have a futures-based ETH
Yeah,
yet
gotcha.
in
How
Canada.
do they track the spot though in general? Just like the actual spot ETF versus
That's a
actual
very
spot.
good question.
Right. So in the let me just look at this here. I'm not sharing my screen anymore, right? So
What do you mean? How do they track the spot?
Well,
Because the ETFs
How does
actually
one
own the
define
spot.
spot across 100 different
Right.
Bitcoin
Like whatever
exchanges?
you got on like Coinbase or whatever like you own
Yeah.
it in a wallet.
What's the
that
truth?
price.
right.
There's
Yeah,
an
so I'm just
index,
wondering,
right?
like,
So they
the
set the
exact
price
cost.
based on the TWAP or the VWAP in the last 5 minutes of trading prior to 4 p.m. or something like that.
This is
Yeah.
actually part of the challenge, right? That the investors want to be very clear on. I want you to tell me what the index is. Is it a futures-based index? Is it a spot-based index? What time of day are we tracking it, right? Is it 4 o'clock? Is it
Yeah.
8 o'clock? On what exchange? Average of a number of exchanges. And so like that all gets, I guess, well defined, but is actually quite tricky. If you look at Purpose and so their launch of the ETF and their tracking to their index was terrible. I mean,
Really?
was hundreds of basis points.
Wow.
And so, it may have settled down. I haven't looked recently, but this is the, sort of the number one bugaboo. And I guess, from the perspective of a lot of the index providers, what I understand is they're actually looking to the futures markets to provide that type of index. And let's face it, it's a really interesting problem with this particular type of asset class. It's not as bad as oil. Thinking about, am I am I rolling front month or 12 month?
Yeah.
But there's some challenges in there, and you got two different types of ecosystems. You've got a Bitcoin ecosystem, which is very expensive to move things from, physical to warm to cold storage, and then back out, and you're doing creates and redeems daily. That for the vast majority of those physical coined ETFs, in my mind, they're probably using futures, I would think, quite actively to hedge that underlying exposure. They're certainly not going and putting Bitcoin in cold storage during the day. I don't think.
Yeah. Well, it's super. I'm
Anyway.
also wondering how much, because you got the trust down here. Remember, I can't remember what it's called, but the
Grayscale?
Grayscale.
Yeah, Grayscale Trust, where they got all the arbitrage on like premium discount.
Yeah.
And I assume there's like huge future players like doing the spread trade. So I can't imagine that as people just launch more and more product, whether it's future, cash base, what have you, that all these things will just get tighter because of no arbitrage. And people like to make money in the markets.
The other thing you do in Canada on the closed-end funds is they have a requirement for a monthly redemption at 95% and an annual redemption at NAV.
Oh wow!
And so we had a way back years ago, we had a closed-end fund whirlwind of speculation that led to a whole bunch of closed-end funds trading at massive discounts. And the regulators just said, if you're going to open a closed-end fund, you have to have these two requirements. So at least once annually, some redemption feature of X versus Y.
It's just so sensible. Like, I don't understand why that's not the same.
Everybody wants permanent capital,
rules
man.
in the States.
Yeah.
I understand it from the perspective of the issuer. Like, if I'm GBTC, I'm wondering, why would I ever convert? I've got captive capital. I'm able to charge whatever I want over the course of the basically perpetuity. But like from the perspective of the SEC, why wouldn't they take the same perspective? Anyways, this is a bit of off-roading, but it is curious.
Do we have a question for Patrick, or are we just going to talk Adam for the rest of the day? Patrick, can you talk about this at all right now? Like, what are your thoughts on this whole space?
So to kind of tie into what Mike was saying earlier, everybody, at least in our experience, talking to lawyers that are filing these things left and right nonstop, they don't have good answers to those questions either. And so what are they trying to do? They're trying to write the broadest, most vague. Canada is triple black belt, calc level 3, and the Americans are in 4th grade still trying to get, the flashcards written and made. So it's like these disclosures are just we're providing broad, we're targeting the price of Bitcoin and maybe other things. And then you talk about the leverage limitations and all these other, if you're using a blocker, a Cayman blocker. I think it's just so elementary because the ecosystem is not shopped out. And you're absolutely right, Mike. Like if you just say we're going to track the price of Bitcoin, a retail investor is like, okay, cool, like got it.
Yeah.
But like and that's why a fiduciary is so key. Like guys like you that actually understand this stuff, where you can actually say, okay, no, we actually have to unfold that a little bit or unpack that a little bit and get into the specifics. So I think this is just as you guys probably talked about before, it's a land grab. Who can get there as quick as possible, and hopefully without getting sanctioned by the regulators. You just got to work with people that know what the heck they're doing.
Yeah. Well, the interesting thing is futures have sort of been granted the, all clear, not all, like sort of Bitcoin and Ethereum.
Yeah.
Ethereum in particular has, I think, a sort of this legislative ruling in its favor of, and Bitcoin is a slightly different interpretation, but they have been interpreted from a tax guideline perspective, as I understand it, as being fairly clear.
Yep.
And so, and then recently we've seen the news that, hey, we would support, an ecosystem that used these types of instruments underlying, which is great. I mean, this opens up the door for, U.S. investors who've had a heck of a time, or, Canada and South America has launched several products in this thing. The Middle East. I mean, I think the 3iQ product almost trades like 22 hours a day because it's listed on a number of exchanges across the world. And then you, as you said, you've got sort of, I mean, fourth grade in the U.S. It's harsh. Maybe it's sort of semi-true, but I just a slower adoption in the face of pretty substantial investor demand. I mean, you just look over to Coinbase and see the number of accounts they have. It's larger than the number of accounts at like Schwab, TD, and Fidelity. It's some ridiculous thing like that Matt talks about from Bitwise. And so you're seeing mass adoption, like you're seeing some sort of movement within sort of a retail space anyway. So it's just a really interesting space, but there's a lot of thought that has to go into how one might get exposure. And I think just one last thing, Rob, before you jump in, not your keys, not your coins is an extremely dangerous statement. When someone thinks about a bearer asset that you will own, that has a whole set of different security precautions that you would have to take as an individual rather than owning a financialized product.
Right.
And this is where I think that's the gap I kind of, if I gasp at anything in the US regulators, that's where I would be like, okay, come on. You're forcing a whole bunch of people to hold this bearer asset in a way where, like, let's just financialize the asset and allow the access.
This IBM certificate from your grandmother that's in your home safe.
Correct.
Right? Like
with a signature on the back, right?
That's right.
Like I've signed it and I put it in the vault.
Yeah.
You know what's funny about that? I was actually at a conference last weekend because I'm not I don't know that much about this crypto stuff, but everyone there knew a lot about it, and they're also half my age and 10 times richer. And one of the guys actually told me, because he's one of these like hodl guys, and he's pretty famous, and he says like the security thing is real, like because they know, oh, this guy, if I know he owns his own wallet, I'll go put a gun to his head because I know he is literally holding this. And he knows the password somewhere. I can just steal $10 million.
Gun to his head?
Brother,
no,
Mike.
We're not going to put a gun to his head. We're going to chop off his left hand.
Yeah, or whatever.
So he can still use his right hand to punch the keys and then figure out how much he would like to have his right hand.
I know. So he had part of his crypto thing is he literally has like security protocols. Like I was like, wow, I never even thought about that. That's
do security or did security?
My brother does. My brother does corporate security, and he has worked for several, both movie stars, but also crypto. So done full housing design, panic room type stuff. Drive routes before they go somewhere. Make sure they have escape routes, all that stuff. Because you're talking people with serious. Coin,
yeah, I mean, it would be the
obviously.
equivalent of a billionaire having all of his money in gold bars in his home, right? Like
Yeah, it is.
The only reason billionaires can walk around is because nobody can get access to it even if they capture them, right? So it's just such a silly thing.
Anyway.
Now, Patrick, just back to the question, like just from a regulatory perspective, I'm curious whether you have all these different offerings trying to get to market, and we've talked about the complexities of pricing and how are you going to get access to it. Is it that the regulators are being thrown 20 different ways of getting exposure to Bitcoin and they don't know what to do about it?
Yeah, I mean, I don't know if this is the beauty of the American bureaucratic design that the forefathers made 300 or our founding fathers made, 250 to 300 years ago or what, but yet you've got three key issues. You've got one, Fed wants to treat it like a currency, SEC wants to treat it like a security, and Congress is getting pulled in other directions. And you can look at like the letter Senator Warren sent to Gensler and says, you need to regulate Bitcoin, get your act together. And then Gensler's like, hey, this is really cool. As soon as Congress writes a law that gives me the mandate to regulate this, I'll be more than happy to help you, Senator. It was the most passive aggressive response ever. So yeah, I think it's just, this, we are not, I mean, even across democracies, we're more fragmented and slower, if you will. And I think just this new innovative product. I mean, you saw the Facebook hearings. Like we have senators that can't understand what Facebook is. You want to try and explain crypto to them? It's just a whole nother level, jujitsu level of knowledge that they don't have. So,
but isn't that a false excuse? Like, come on, how much knowledge do these senators have about natural gas exploration, or junior silver mines, or junior lithium mines, or triple leveraged silver ETFs? Like, honestly, isn't that a bit of a cop out?
So I agree with you. It is a cop out. And why is it a cop out? It's a cop out because these, crypto is a great disintermediator on so many levels, right? You think about all the, being able to just buy currency without paying a commission, being able to,
Jamie Dimon's thinking about it, and he's in the news every day.
Yeah, right.
Talking his book.
Yeah. So is all of this a false flag? Oh, we got to take our time. We got to really evaluate this. How much of that is genuine versus, I got to protect my job. I don't know, but I definitely the latter. I think to some extent.
It's a.
That's a good cynical take. You could.
Am I not here?
I'm totally buying that. But there's also I guess a reserve currency question and an AML question, and there's obviously a massive interest in, especially in the U.S. for AML, anti-terrorism, and border control and war on drugs. There's just so many competing interests to make sure that you don't enable money laundering and all that kind of stuff. I guess that you if you wanted to be generous in your interpretation of what's taking so long, then you've got a few excuses. So unlike me to give them these outs.
Yeah, there you go.
Well, this guy.
I've been reading your Twitter profile recently, Adam. You certainly, that is very.
You were much more in Patrick's camp. What's going on?
I
had
far
to
in my
disengage.
camp now. I gotta.
So Patrick, one of the questions with regard to ETFs and Bitcoin, right? Bitcoin trades 24/7. An ETF product will trade 5 days a week, half the day or less than that. There's also always overnight markets, right, in stocks where things trade in different ways. What do we expect that to be if we were ever to launch a Bitcoin ETF that can mark to market somewhat? Like, do you expect these shares to trade overnight, overseas, over the weekend?
We haven't gotten that far, and that is what terrifies me about these things, right? Is how do you manage that over a weekend? Right? I mean, we have all this extra plumbing for international funds with just a 12-hour time zone difference. If you have a fund that holds, Japanese securities, all of these valuation procedures come into play. So I think I think the path that the U.S. is on is a good one, which is, look, we have to get on board with something. The futures markets can handle this, and let's kind of rip the Band-Aid off in this one sector and see what happens. But I think it's going to be a lot of, watch and observe and see what happens. So I don't have a good answer on that, frankly.
What's the opportunity for those who, the roll yields in obviously OTC futures against spot have been pretty juicy since the origination of crypto. Do you envision a big portion of the use case for these types of futures-based products being to facilitate this kind of arb for people that don't have derivatives licenses, or is that a big? I would think that'd be massive, but I just have I don't know.
I don't know. I would think whenever that has to get arbed away at some point. I just don't see how that's sustainable longer term. I don't know, Wes. Do you have?
A lot of times futures are in contango backwardation for a reason. I'm sure the one in crypto might be inefficient right now, but over time, usually there's a reason for these things, right? It's like VIX. I know that if I short VIX futures, in theory, I could make 20%, but I can also die tomorrow, right? And so usually prices are roughly correct. And markets are roughly efficient. And that may not be the case right now, but I can only imagine that if and when a lot more products come online, a lot more cross arbitrage, a lot more capital comes in this game. Let's say the whole curve is super contango, it's probably that way for a reason.
Well, I think it's that way because it's so far been really challenging to take a meaningful proportion of fiat and move it into the crypto ecosystem. It's just really hard, and it's really risky. Fiduciaries perceive it as risky.
Yep.
There's a lot of, I don't know why my Siri keeps popping up.
It's a self-financing organism or ecosystem as well, right? So the cost of funds is a little bit different.
Yep.
It's not, Schedule 1 bank finance through lots of money sitting on balance sheets to fund whatever you need to take whatever arb out of whatever, financially approved market.
Yeah.
But it's just really hard for institutions. The vast majority of capital is held at institutions. It's very hard for institutions. The other side of the arb is you got to hold spot Bitcoin, right? So that is the hard part, right? So you've got people want to get exposure to the asset. They can't get exposure by buying spot because moving from fiat into the crypto ecosystem is risky for a variety of reasons: tax, regulatory, fiduciary, ERISA, whatever. Personal. Yeah. And so you've got this massive supply demand imbalance. And so that needs to be funded by whatever capital is in the crypto ecosystem needs to fund that, and it needs to get an equivalent rate. And so until they make it easy regulatorily, tax, and through the financial system to move a meaningful proportion of institutional capital into the crypto ecosystem where they can own spot against the futures to arb the basis, this thing's going to be really juicy. Yeah. So I think that I can't imagine that's not going to be a major use case for products like this.
I know I promised Wes that we would let him go 6 minutes ago. Wes, how you doing? You got to hop off.
Yeah, I'm good. I actually got to leave in about 9 here. I got to call at 5, but I can.
You can drop off whenever you need.
Yeah, I'll just.
Who do you have to talk to, Wes? These guys have been in the trenches with us for years.
I know. Well, you can look at my calendar. I can't exactly miss it. To see who's on there.
Justin Bieber concert. Got it.
Yeah.
Okay.
Yeah.
Justin Bieber's doing a live stream.
Yeah.
Surf professor.
He's doing a live. He's down at the sandbar.
Yeah. But the other thing is, I just know, just from seeing on the private side, there's a ton of capital going into, hedge funds or whatever that are doing like arbitrage. So like, hey, it may not be going through the formal markets, but there's a ton of hedge funds that are raising a ton of capital to do arbitrage activity and making spreads and making markets. So it may not be like Susquehanna. Well, it is probably Susquehanna, but it may not be like well-known players, but there's definitely huge operators that are raising.
So I can give some insight into that. But Mike, can we talk? Can we talk about this?
We can talk generally about insights that we would have on that particular topic. Yes.
Yeah, maybe. All right.
So here are some insights generally about.
I hate this industry.
We can talk about insights that we might have on that particular topic.
There is a lot of interest from Susquehanna and the big prop desks, people that have built private, that are reaching out to certain firms outside of the U.S. jurisdiction, no firm to be named, because they can't do the trading themselves. If you're an American and if you're a resident of the United States and you try to arb out this spot versus derivatives across 100 different exchanges, right? You're not allowed to trade derivatives. It's illegal, right? So you can't even
exchanges
VPN
won't allow Americans, right?
Americans to trade in those securities.
Exchanges won't allow Americans because they don't want the ire of the American regulatory, the global lead of regulatory financial assets. They don't want to fear that ire because it's too big of a market.
So what they're doing for the first time ever in their experience, because they generally do they have their own trading desk. That for the first time that I've seen that have been reaching out to offshore companies, let's just say, that are already running these type of arbitrages, they're willing to buy the fund for the first time. So I think,
honestly,
until
Rod,
something gets regulated for the United States that allows these big firms to trade offshore in this space, there will be a ton of dislocations. And also, the other thing, we're not talking about dealing with 2 or 3 exchanges here. We're talking about 100 different exchanges that all have their own spot price Bitcoin at any given time during the day. So there's just, I think this juice is going to be available for a long time, and even the big firms won't be able to take advantage of it.
I would add, Rod, we've even seen those types of companies setting up their offshore arms, right? So you see them setting up in Bahamas or Cayman or wherever because they can't do it from U.S. soil. So they're of course, and they're setting up arms, which they're doing. I mean, that is happening. So there's a flow of talent and capital that's leaving the United States in order to accomplish this as well, which is something that.
But the point is, like, to Wes's
wonderful.
Point,
they'll get their head around that.
Definitely, yeah. But to Wes's point, right? There are absolutely ARB funds that are being set up, but in the context of a $2 trillion market cap ecosystem, $1 billion here and $1 billion there in these ARB funds is a drop in the bucket, right? So until the U.S., primarily the U.S., there's other jurisdictions that threw up barriers as well, but until the U.S. unburdens or liberalizes some of the regs around this, it's just going to be virtually impossible for a meaningful amount of capital flow into this from at an institutional level to close these gaps. I mean, we observe these constantly, and the opportunity in ARBs of all types have not converged in any meaningful way at all over the last 9 to 12 months as we've been sort of scrutinizing fairly closely. So, I think products like this, that sort of futures-based ETFs, are an interesting way for institutions to be able to, in a time of razor thin yields everywhere, this is a very attractive yield product if done properly. So it'll be interesting to see how the demand for that evolves from institutions.
Well, gosh, we've even done a split share corp here in Canada, right?
Yeah.
Here in Canada, I'm not in Canada, but in Canada there was a split share corp. But I don't know if you remember this happened in the U.S. a lot. But they take an asset, they do some covered writing, they do 2 tranches, they have a preferred share and a capital share, right? The cap share is levered 2 times, and the preferred share single leverage but 6% yield, and the preferred share has a
all the dividends accrue to the preferred share,
Yeah.
and and there's a guaranteed
and what's
yield
left over accrues to the Anyway, so that I mean, those were circa the year 2000, 2001. They're again a product in Canada, and we saw them on Canadian oil sands and all kinds of weird resource stuff, and now being marketed for Bitcoin as well. So the flows are
covered
interesting.
calls for the income sleeve, which is a pretty neat strategy.
100 vol asset. It's not a horrible
exactly.
thing, let's face it.
Well, I mean, what is the yield? I don't look at the implied vol on these things. Well, like if you do like a
yield
covered call
today on
equivalent
Ethereum.
Yeah, like what's the yield? Like what do you?
What was the
what
yield
is it
today
like?
on Ethereum? If you were
Well, that was
annualized, but it
was
wasn't-
yeah, that was 70%, but it was for a few hours, and it was against.
That's pretty good.
But no, covered writing is a different. But I mean, just the options are 100 vol plus 100 to 150 vol. So I don't know. You get 25% downside protection, I guess, about if you do a covered write.
Yeah.
Wow, that's amazing. That's amazing.
And the bid ask spread to get them is probably like 25.01 or something.
Well, I mean, it depends where you are in the ladder of, but yeah, it can be. And then a lot of those types of products, when you go off into the world outside of the United States, are actually RFQ, right? So there is no option ladder. You just put in. They give you a quote of what you get to totally tailor your option to whatever it is that you would like. Days, amount from strike, etc. Totally customized. Obviously, when you go to sell said option or close said position, you're also going to them for an RFQ. So that's probably a little unnerving, or could be.
Are you expecting that that these ETFs are going to be optionable eventually? Like presumably they'll be optionable relatively quickly. It's probably not even on your radar, is it?
Yeah, I mean, someone just has to, get the ISDA. I mean, someone's going to be doing it for sure. Someone's going to get the ISDA in place, and then again, it's the derivative.
No, I mean like publicly, just like public option chains on the listed ETF, even.
Yeah.
Right.
Yeah, for sure.
Yeah, no, that's.
If someone can make money, they'll probably launch it.
It's
usually how it works.
Figure out how. I mean, but today, is anybody beating rigs today? Come on, that thing's got to be on fuego.
We can either confirm nor deny any of.
No, rigs
right.
is
Can't
an
talk
ETF
about
you
it.
have, no?
Yeah.
20,000.
Well, here's what I'll say, Mike.
You guys want to talk about value investing?
Yeah. I was about to say that. Let me tell you about value investing. We probably spent what? Because we've been doing that since 2012. And that's a long time. And then I can compare that against some crypto mining thing. And I'm like, wow, the NAVs are the same. Except one's been around for 9 years now. And the other one's been around for 2 months. I just gave up thinking too hard, Mike. I don't understand how it works anymore, but that's all right.
No, I'm a
We're
big
trying
fan
real
of
hard over here.
A moment of silence for thinking too hard, Wes.
Yeah. You and Adam should start a help group or something.
That's right. Exactly.
that's right.
We hold hands.
Mike doesn't think at all.
Now, Mike, you know what we started? A shovel selling group. That's what we started. I'm not gold mining anymore.
We thought about
selling.
it. We thought about it, and we said, we should sell these dummies picks and shovels. I mean, what?
Exactly. All right. Well, I got to bounce. You guys could talk about important stuff.
Wes.
Adios.
Thanks, Wes,
Good to
brother.
see you,
Hey,
bud.
Wes,
Good
are
to
we
see you,
doing
man.
March for the Fallen next year?
Let's go. Let's go. That's
March-
who's gonna go.
Yeah, he's just left.
Hey, you
Good to
guys
go.
hiring? You guys hiring? This isn't live, right? We can just
We're
talk.
off the air, right?
Hey, what's
Somebody
going
shitting on you with all these launches?
on? No,
Can't imagine
it's
it's
good.
easy.
No, it's good. It's fun. I like what I like about it is you get to talk to these lawyers. You're talking to the SEC every day about just all the crazy stuff that's going on behind the scenes. Like someone files and they want to use the Canadian ETFs in their crypto product, and then the SEC calls them 24 hours later and says, "No, you can't do this." It's just that's the fun part, I think. But Yeah, everyone has
So
ETF on the
that's
brain because of tax efficiency.
that's an interesting question with regard to, you guys are launching or have launched and are running this Alpha Architect. What do you call it? The Alpha Architect,
ETF Architect.
ETF Architect.
ETF Architect. Yeah.
So the ETF Architect
I like it,
process,
man. I
you're
like it.
talking
Thank
about
you, Shane.
minimizing
That's awesome.
costs and all that, but there's got to be operational alpha, and I imagine a lot of operational with connections with the right lawyers and the right people to talk to in the regulatory environment.
That's a good question.
Well, yeah. I mean, just like you guys, right? Like we've been in the trenches for a long time together, and you start to learn how to set this stuff up. You start to learn, and the thing is we were broke to start, right? So this industry was built, and Mike, I mean, back your days at Scotiabank, like you had the infrastructure, you had the personnel, and now it's like, okay, now you're going to be in Toronto in an apartment, you just got to figure it out. The same thing with us, right? So yeah, there is a lot. There's a ton of fat in this industry still. I mean, it's a bloodbath, right? But there's still a ton of fat, and there's all these things. I mean, I think there should be a day where you should be able to launch an ETF for under 10 grand. There's no reason.
Well, how do you guys price that now? Because Wes said something about having 500 grand in operating capital to sort of start.
For
But
2
what's
years.
how do you divide that up between the ongoing operating cost versus the launching costs?
So the operating capital requirement, you have two. I mean, funds close all the time, right? So you want to try and separate the wheat from the chaff. So we basically say, look, the ongoing cost of running an ETF, call it very ballpark, call it 20K a month. Like we want you to live for at least 2 years with like no success, right? And so that's why we throw that number out there. But the operating costs, right now we're seeing like about 60K, maybe 70K if you're doing something more exotic. But when I look at the work, when I'm the one, making the sausage in the back with the attorneys, I'm like, this is so inefficient. This is so 1980s. We're still like, we don't have a fax and we don't have like green visors with like calculators, but it's almost that bad.
The abacus.
Yeah. So yeah, but what you guys are doing, I mean, you guys are innovators and super smart and nimble, and you're doing things that no one else is doing. And I mean, that's just, I think it's kind of two different sides of the same coin, frankly. Just need new blood in there to like figure it out. So,
Well, I think we're continuing to operate in a 1980s paradigm, right? And sometime over the next 5 or 10 years, this entire tech will become antiquated, and it'll just move entirely into the tokenization space, into DAOs, and all of this stuff, which was designed to work with fax machines and two people sitting in an office signing papers, right?
Yeah.
Will be recognized as the antiquated tech it is, and there'll be viable alternatives that everyone will agree to, right? At the moment, we haven't converged on a common narrative where that's accepted, but it's coming.
yeah.
But it's
yeah.
a combination of the 40-year-old tech and the 80-year-old law. I mean, is it 80 years? Yeah, the 1940 Act, right?
Yeah.
1940 for a reason. A lot of it, we go back to that over and over
Well,
again.
not much has
to
changed,
figure
Rob.
out what we
What do
can
you
or
mean?
can't do.
Yeah. Yeah, it's the law. Well, I mean, and to the SEC's credit, like they are trying their damnedest to keep this thing updated. They did the ETF rule. They got custom baskets allowed. They're trying to figure out how to satiate the demand for crypto, right? But you're right, Rodrigo. It's it's still these old rules. And I will say another part of operational alpha, and this, I hate to sound hokey, but it's also just like you got to be good people, right? Like there's no substitute. You can be you guys know you can be the smartest person, but Philbrick's the one cracking jokes up front, and like, people like, how could you not want to follow Philbrick onto the football field? I ask myself that every
That is
day.
true. That is true. Just don't eat the donuts.
Yeah, don't eat the donuts. Story for another day.
Why? Why
Those
is
who
it
know,
another
know.
day? I swear to God, one day you're going to have to say,
I'm
tell
not
that
talking
story
about
live.
that.
It's all Riffs. Have a few more
That's
drinks.
not happening right now. Those who know, and those who don't know can use their imagination.
Yeah. But
So
no,
it's do you have like a crew of lawyers internally that deal with all this, or do you have lawyers externally that you like to work with that know the space, that connections and all that important?
Yeah, the latter, and I think
Wes is not going to retain in-house counsel. What are you talking about the same guy?
Yeah, what you
Good
do
God.
is you find a washed-up MBA with no hair and just trying to prove something to his wife, who long ago gave up on their marriage, and then you have him. No, yeah. What we try and do is we try and like deconstruct all that crap. Or say, okay, where are the legal minds best suited? Well, okay, they're best suited for these pieces, and then okay, what can be done by an idiot? And then we try and replicate that or outsource that, and do it quickly. And then you pull in the lawyer, and then what you say is you say, look, give us a good discount on price, we'll make up in volume. And then what we try to do is we try and just keep them engaged on the stuff that actually matters, on the stuff that is worth $500, $1,000 an hour, and not page numbers and stuff like that. So,
No, that's good
No, that's
insight. And
huge.
trying
That
to
is a
keep
huge thing.
lawyers to, the core task, the most important task, not, prevent scope drift. Like so much extra costing comes from just not staying on all of the service providers who are all obscenely expensive. Like what, and this is less true with, I know what you're currently doing in the crypto space, but a lot of what all of everybody's doing in the ETF space, we're not reinventing the wheel every time we file a prospectus. Like 80 to 90% of that copy is template. And yet somehow the lawyers get away with charging everybody the same amount as though they need to completely recreate each document from scratch at $500 to $1,000 an hour. And so getting good service people who are willing to cut you a break and recognize that there's a lot of overlap from prospectus to prospectus or from filing to filing, I'm sure that's got to come in handy.
Well, correct me if I'm wrong, Patrick, but the reason you have your template is because we've been told by our Canadian lawyers, at least, that they're not allowed to copy somebody else's prospectus, right? That they're not allowed to copy somebody else's compliance document. That is unethical from a legal perspective, that we have to do something unique for you. And so they get away with creating something from scratch. If you're internally coming in with a document that's 90% filled in and then saying, just fill in the 10% that we actually don't know about, you're probably able to get a much better, that type of operational alpha that we're talking about.
Yeah, I mean, boy, we look at it down here as, what is the purpose of these legal documents? These purpose of the documents are to protect the investor at the end of the day, right? It's to clearly and succinctly explain what the heck grandma is buying in her Schwab account. So if there's a better disclosure out there, if there's a better mousetrap, everybody's better served. And are we just copy pasting an iShares prospectus and dropping it in? No, you still have to think about the risks and all that stuff. But yeah, I mean, how many long only funds need to be rewritten from scratch? Come on.
Well, this is what always
talk to three different lawyers to get three different answers.
Yeah, and you just and here's a great source of operational alpha for us. Like, don't be a dick. If you respect a service provider's time and a weekend and 9 to 5, do your best when you can. Like, they're gonna like working with it. They're gonna cut you a deal, because they have plenty of clients in New York that are sending them emails at 8 o'clock on a Friday and asking them. And sometimes we have to do that, but that to me has been the most surprising source of alpha, if you will. It's like, just respect people's work-life balance, and they will seek you out.
Right.
So
that's great.
Yeah.
What a whirlwind of a career you've had with Alpha Architect from when we first met. Yeah,
man, it's been
found your niche and crushing it.
You try some stuff, you pivot. You try some stuff, you pivot. You guys have been very open-minded and opportunistic. I think pretty commercial.
Oh, it's been incredible,
the journey that you guys have been on.
Yep. Well, and to you guys too. I mean, I look at you guys, as a not benchmarking in a competitive way, but just, hey, who's doing what? And one thing I really admire about your shop is just how the quality of content, but it's not just quality. It's like, it looks good. It's packaged well. It's deliverable to someone without a PhD, right? And I've always admired that about you guys. So,
well, Rod's the design guy for sure. He's got
definitely.
that.
Well, Patrick, I mean it. Like I was telling my wife the other day that it's so rare literally yesterday I was talking about your success, the Alpha Architect success, and how I was someone would see from the outside that we may be competitors. I never see ourselves as that, but I literally was almost overjoyed with tears of your success over the last few months. And,
thanks, guys.
Like you guys are an incredibly genuine team. Really love you guys, and I'm really proud of what you guys have accomplished, and I'm sure you'll continue to create amazing things.
This most recent win, especially, this is absolutely magnificent. We were all celebrating on your behalf.
Yeah, we're really excited about the new lease we signed. Very excited about it. Overjoyed.
At the house that you're in with that.
Yeah, we are getting an office. I'm stoked. We're getting like a real office with
That's
bathrooms.
End of an era,
Really?
man.
Are you really stoked?
Yeah.
Or are you a little bit disappointed?
Yes.
I don't know. You'll remember this with fondness.
Yeah, no, it's
amen to that.
Agreed.
Amen to that. I did love the one. I think it was I can't remember. It was a Twitter video or something you posted with the back test a guy sent you to launch an ETF back in the day. That made me cry with laughter. And you put it in the fireplace. That was beautiful. I get those emails too.
Pray tell, what was? Can you flesh that one out a little bit more?
Yeah, so Wes is like, we need to be funny, we need to be edgy, and you don't have a PhD, so you had no intellectual value. Do something funny on camera. And I was like, okay.
Adam says the same thing to Rod and I.
So I made some video. He's coming back, by the way. But I made some videos of like basically a guy's like, oh, you have a back test and a good idea? Let me run that through our due diligence department. And I like pick up a stack of papers and then I like throw it in these roaring flames off camera. We will get right back to you. Stuff like that. So
I remember now.
I like it. Bring him back.
Yeah,
We want him back.
Yeah, he's gonna come back. So
I love it.
Well, thanks for having us on, guys. It's awesome.
Thank you.
And,
Thanks for
We're
coming on.
looking forward to
Last
catching
minute.
up again.
Insightful as always.
Yeah.
Congrats, and
and
we'll chat again.
And where, like, everyone can find Alpha Architect, where can they find the ETF Architect side of things? Is that on the Alpha Architect site? What? How do people find you guys?
Actually, Patrick, just summarize what exactly this is and who your target client is, and what are you guys trying to build here?
All right. So we are targeting folks that are trying to launch ETFs, preferably folks with operating capital, a reasonable roadmap to 50 million. You don't have to be iShares or BlackRock, but we try and find folks that have a distribution plan, because distribution is the ETF business, like it or not. And then we're just trying to build a co-op of good people that want to share in low cost. I mean, that's pretty much what we do. We say, look, everybody has this fixed cost infrastructure. If we get good people we trust, good compliance operators, we can all just operate on a much lower cost basis. And that's pretty much it. I mean, we just want to build a never land of children trying to make it in this crazy world.
And I will say,
edit that out. This isn't live, right? We can edit that out. Great.
Yeah, that's going. I'm going to put in the beginning and the end. It's going to be like opening snippet.
With like Tiger Lily and stuff inside the background.
I think that the podcast you do with Meb, if anybody wants to get deep, really understand the journey,
agreed.
The podcast that Meb did with Pat and Wes was absolutely amazing. Look it up and get into it. And do hit the like button before we all leave, and subscribe and share and all that fun stuff. Pat, thank you so much, man. That was awesome, and keep at it.
Hopefully we'll see you in person soon, man. It's been too long.
Well, I'll be in Puerto Rico in March 8th.
Really?
To the 8th, yeah. So are you gonna?
It's Puerto Rico in spirit lots of times, but
yeah. So you guys are in the Caymans, and Wes is in Puerto Rico, and I'm in Philadelphia, which just makes me question all sorts of life choices.
Yeah, wow.
So,
yeah, but they're your choices, Pat.
I know.
Yeah. Are you American, Pat?
What's going on?
I'm American. I'm eligible for Canadian citizenship, though. My dad was born in Alberta. Yeah.
Well,
yeah.
Let me show you around Grand Cayman.
Good stuff, guys. Thanks for the opportunity.
All right, guys.
all right. Have a
Thanks.
great evening.
Thanks for
and a
joining us
great
on this Friday, everyone.
weekend. Yeah. Thanks, guys.
Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA. and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.